The Bank of England has raised interest rates for the 12th time in a row to 4.5%, the highest level since 2008. This is part of its strategy to fight inflation, which is above 10% in the UK, the highest among the G7 countries. But how does this rate hike affect the inflation and the purchasing power of your money? Inflation is the general increase in the prices of goods and services over time. It means that your money can buy less than it used to. For example, if inflation is 10%, a loaf of bread that cost £1 last year will cost £1.10 this year. The purchasing power of your money has decreased by 10%. One of the main causes of inflation is the demand for goods and services exceeding the supply. When there is more money chasing fewer goods, sellers can raise their prices and buyers have to pay more. This can create a vicious cycle, as higher prices reduce the real income of consumers, who then demand higher wages to maintain their living standards. Higher wages increase the costs of production for firms, who then pass on these costs to consumers by raising their prices again. Another cause of inflation is the increase in the costs of raw materials, such as food and energy. These are essential inputs for many goods and services, and when their prices go up, so do the prices of everything else that depends on them. For example, higher food prices mean higher costs for restaurants, supermarkets, and households. Higher energy prices mean higher costs for transport, heating, and electricity. The Bank of England's main tool to control inflation is the interest rate, which is the cost of borrowing money. By raising the interest rate, the bank makes borrowing more expensive and saving more attractive. This reduces the amount of money available for spending and investing, which lowers the demand for goods and services. This also reduces the pressure on wages and prices, as firms and consumers have less money to bid up their costs. By lowering inflation, the bank aims to preserve the value of money and protect the purchasing power of consumers and savers. However, raising interest rates also has some negative effects on the economy. Higher interest rates make mortgages and loans more expensive, which reduces the demand for housing and other big-ticket items. This can hurt the construction sector and other related industries. Higher interest rates also make it harder for businesses to borrow money for expansion and innovation, which can slow down economic growth and job creation. Therefore, the bank has to balance the benefits and costs of raising interest rates, and find an optimal level that keeps inflation close to its target of 2% without harming economic activity too much. The bank also has to consider other factors that affect inflation, such as exchange rates, fiscal policy, global events, and expectations. The bank's latest decision to raise interest rates by 0.25 percentage points reflects its assessment that inflation will stay higher for longer than previously expected, due to high food prices and a resilient jobs market. The bank also upgraded its projections for economic growth, as it no longer sees a recession this year. However, the bank also warned that there are significant uncertainties around its forecasts, and that it will monitor closely how the economy responds to its policy actions. The bank said it will continue to address the risk of more persistent strength in domestic price and wage setting, which could lead to a more sustained rise in inflation. The bank's next decision on interest rates will be announced on June 15. The Bank of England's 12th rate hike in a row has significant implications for the stock market and the returns on your investments. In this section, we will explore how the rate hike affects different types of stocks, sectors, and industries, and what strategies you can adopt to navigate the changing market conditions. First, let's understand why the Bank of England raised interest rates to 4.5% from 4.25%, its highest level since October 2008. The main reason is to combat inflation, which hit a 40-year high of around 11% in the last quarter of 2022. Inflation erodes the purchasing power of money and reduces the real returns on investments. By raising interest rates, the Bank of England aims to slow down the economy, reduce consumer spending and borrowing, and encourage saving. This should help to bring inflation back to its 2% target in the medium term. However, higher interest rates also have negative effects on the economy and the stock market. Higher interest rates make borrowing more expensive for businesses and consumers, which can reduce their profits and spending. This can lead to lower economic growth, lower corporate earnings, and lower stock prices. Higher interest rates also increase the opportunity cost of investing in stocks, as cash and bonds become more attractive alternatives. This can reduce the demand for stocks and lower their valuations. Not all stocks are affected equally by higher interest rates. Generally speaking, growth stocks are more sensitive to interest rate changes than value stocks. Growth stocks are those that are expected to grow their earnings faster than the market average, such as technology, biotechnology, and consumer discretionary stocks. These stocks tend to have high valuations based on their future cash flows, which are discounted back to the present day using interest rates. When interest rates rise, the present value of these future cash flows decreases, making growth stocks less attractive. Value stocks are those that are undervalued by the market based on their current earnings, assets, or dividends, such as financials, energy, and utilities stocks. These stocks tend to have low valuations based on their current cash flows, which are less affected by interest rate changes. Value stocks may also benefit from higher interest rates if they operate in sectors that benefit from higher inflation or higher economic activity. Some sectors and industries are more resilient than others to higher interest rates. For example, financials tend to benefit from higher interest rates as they can charge higher interest rates on loans and earn higher margins. Energy and commodities tend to benefit from higher inflation as they can pass on higher costs to consumers. Utilities tend to be stable as they provide essential services that are regulated and have predictable cash flows. Some sectors and industries are more vulnerable than others to higher interest rates. For example, consumer discretionary tend to suffer from higher interest rates as they depend on consumer spending and confidence, which can decline when borrowing costs rise. Technology tends to suffer from higher interest rates as they have high valuations based on future growth prospects, which are discounted by higher interest rates. Real estate tends to suffer from higher interest rates as they increase the cost of mortgages and reduce the demand for property. To cope with the effects of higher interest rates on the stock market and your investments, you may want to consider some strategies such as diversifying your portfolio across different sectors, industries, and geographies that have different sensitivities to interest rate changes. Rebalancing your portfolio periodically to adjust your exposure to growth and value stocks according to your risk tolerance and investment objectives. Focusing on quality stocks that have strong balance sheets, competitive advantages, consistent earnings, and dividends that can withstand economic downturns and inflation pressures. Seeking opportunities in sectors and industries that may benefit from higher interest rates or inflation, such as financials, energy, and commodities. Avoiding or reducing exposure to sectors and industries that may suffer from higher interest rates or lower economic growth, such as consumer discretionary, technology, and real estate. These are some of the ways that the Bank of England's 12th rate hike affects the stock market and your investments. Remember that interest rate changes are only one of many factors that influence the stock market performance and your investment returns. You should always do your own research before making any investment decisions and consult a financial advisor if you need professional guidance.